Three ways to legally get out of paying taxes in retirement, says Motley Fool through the Yahoo Finance page, dated April 21st, 2019. This is sent to me from Kathy. I'm not sure what state our friend Kathy is. She goes, "Hey Josh, you want to tangle with Motley Fool's suggestion to invest in municipal bonds to avoid paying taxes in retirement?" Well, let's see what we got here. So yes, I do, because I have a sneaky suspicion they're going to be wrong. But let's read this. Why can I make that? It doesn't allow me to. All right, well, I guess we'll keep like that. All right, so let's face it. Taxes are a drag at any time of life, but in retirement, they can constitute a major strain on your limited financial resources. As such, it pays to find ways to lower your tax burden as a senior, and here are three ways to do it, says the good folks at Motley Fool. This is Maury Backman. Sounds like a hockey player. Maury Backman. IRAs and 401ks come in two main varieties, traditional and Roth. With the former, that'd be traditional, contributions going tax-free and workers get an immediate tax break for funding their retirement accounts. Withdrawals, though, are taxable. Roth accounts work the opposite way. Contributions are made with after-tax dollars, so there's no immediate benefit to funding an account. Tax benefit, that is. Withdrawals, on the other hand, are taken tax-free in retirement, thereby lowering your taxes at a time in life you could really use that flexibility. 100% agree with that. If your company offers a 401k with a Roth feature, you can sign up regardless of how much money you earn. Roth IRAs prohibit high earners from making direct contributions, but if your income is too high to fund a Roth IRA directly, you can then convert it. You can put it to a traditional IRA, non-deductible IRA, and convert it to a Roth after the fact. Just be careful on that. But anyway, yes, you could, absolutely. Invest in municipal bonds is number two. Seniors are generally advised to shift towards more conservative investments as they age, which generally means choosing bonds over stocks, although it's still a good idea to hang on to some stocks in retirement. If you're going to load on bonds, choosing municipal bonds over corporate bonds is a good way to keep your taxes to a minimum. That's because the interest you collect from municipal bonds is always exempt from federal taxes, and if you buy them from your state, they're exempt from state taxes as well. Corporate bond interest, on the other hand, is taxable. All right, so this is where Kathy asks, she quotes, they did say if you load up on bonds, then choosing munis over corporate is a good way to keep your taxes to a minimum. I guess they don't understand the role of adding back in tax-exempt interest has when determining if or how much of your Social Security will be subject to taxation. I wish they had carried it a step further to explain the possible tax on Social Security income being triggered by the tax. 100%, Kat, you're hitting on the head. The problem here is that the tax-exempt bonds do not exempt your Social Security from being tax-free. They don't. They are 100% part of the provisional income rules. The provisional income rules determines how much of your Social Security benefit is subject to taxation. So we don't want municipal bonds. We have two things. We have a traditional 401k, we'll just say we have a Roth IRA, and we got a taxable account. I'll say this until I'm blue in the face, my friends, because we got new subscribers here all the time. A lot of people might not have seen one of the 1,000 videos I've done so far. You want your bonds to be in your IRA as corporate bonds. Corporate bonds pay more than municipal bonds because you don't get the tax benefit of a corporate bond. Are there more risk? Sure, absolutely. If you're doing a mutual, like a total bond index fund, the bulk of that fund will be in the government bonds anyway, so it's less risky, but still, you get about 75%, probably 70% in treasuries and mortgage-backed securities, Ginnie Mae, and the rest in corporate bonds. I got no problem with that. I mean, ideally, I'd rather have all corporate bonds, but either way. So we want that in your IRA. We want stocks in your taxable account. The reason for that is because anything that comes out of your IRA or 401k comes out as ordinary income. That's a fact. So essentially what we're doing is we're taking a low-yielding municipal bond tax-free because we don't want to pay tax on it, but that money is still subject to the provisional income tax rules when it comes to how much of your Social Security benefits taxed. Now what we're doing is we're taking stocks that if we would have left in the taxable account would be taxed as long-term capital gains or qualified dividends, which could be 0 to 15%. But now we're taking that 0 to 15% and we're putting in an ordinary income tax bracket, which will be certainly 12 to 22 to 24% without question. So if you had a 10 to 12% ordinary income tax bracket, your qualified dividends, long-term capital gains are taxed at zero, nothing. If you had a 10, 12, 22 to 24% ordinary income tax bracket, your qualified dividends, long-term capital gains are taxed at 15%. So no matter what, if you're flipping out stocks, putting them into your IRA, and then taking distributions from your IRA of those stocks, you're inherently paying more taxes. But it's even worse because now you have tax-exempt municipal bonds, which give you a lower yield, which, yes, you're not paying income tax on, but are also subject to the provisional income, which says how much your Social Security is subject to taxation. And even worse, because you're swapping out corporate income from a corporate bond income, which is going to be higher, substantially higher than municipal bonds, you're getting less of a yield from the municipal bonds, even if you factor in after-tax income. Especially if you're in a low tax bracket. You don't want any freaking municipal bonds. No, don't do that. Just think about it. Say stocks out here because they're going to be qualified. If taxed all, they'll be qualified dividends, long-term capital gains, which if taxed all will be taxed most likely no more than 15% unless you're making big bucks. And then you have your bonds over here, which come out as ordinary income anyway. I'm telling you, it's a huge mistake people make. Hold investments for at least a year and a day to get the long-term capital gains 100%. And then they talk about you pay nothing. If you earn less than $39,000 as a single taxpayer, you don't pay anything. And if your income is above $39,375, you'll pay just 15%. Is that your... I don't have my tax thing here. I can't remember if that's gross AGI, if that's taxable income. I think it's taxable income. So if you're, I don't know. I'm going to assume that's taxable income because 0 to 10, I think it is. So if it's taxable income at $39,000, you actually have about $51,000 of AGI after you take your $12,000 or even $13,000 standard deduction, depending how old you are. We'll just say 12. So you got $51,000, almost $52,000 of AGI before your long-term capital gains and qualified dividends are subject to taxation. All right, that's a big deal, man. So I'm not a fan of this article. I mean, some of it I am, but they don't talk about the provisional tax rules when it comes to Social Security. They don't talk about the asset location, the difference between ordinary income and long-term capital gains, and that's problematic. So be careful. Do they allow comments on here? I don't think they do right now. I don't see any comments, or else I would comment. Yeah, that's too bad. Generally like the Motley Fool, but some of the articles do leave something to be desired, and this is one of them. So thanks for the email, Kathy. I hope this helps. No municipal bonds. No municipal bonds. Say it with me now. No municipal bonds. Hey, no municipal bonds. You. Hey, no municipal bonds. Everybody, no municipal bonds. You got the mic. We'll see you next time.